After a strong performance by the stock market last year, many people are thinking of moving their cash back into investments. We've heard pundits talking about the pros and cons, but just getting into the markets can be a confusing process. So how can you protect yourself and your portfolio? Manisha Thakor is founder of the Women's Financial Literacy Initiative and co-author of the book, Get Financially Naked. She joins me now with some advice. Hello, Manisha. Great to see you again.
Great to see you, Tanya.
So you say before we start off that there is one question in particular that we have to look out for.
Believe it or not, the four most dangerous words to your portfolio, Tanya, are how should I invest? And that may sound crazy because it seems like such a benign question on the surface. But I like to point out to people, if you were going out, would you say, Manisha, what should I wear? You'd tell me where you were going first, because what you'd wear to shovel snow in would look very different than what you'd wear to a wedding. And it's the same thing with the question, how should I invest? People often ask it without telling the party they're asking it of where they want to go. And that can get you in trouble.
Well, sometimes they don't know yet where they want to go, right?
And that is very true. And sometimes they don't know. Sometimes they haven't really thought about it. Exactly.
So that's the first thing we have to do, right? We have to figure out, what is this particular investment for? Is it for my retirement nest egg? Is it for the next 5 years? What's the goal, right?
Exactly. Question number one, to protect yourself from those four dangerous words, how should I invest, is when do I need to spend that money? And money that you need to spend in the next 1 to 5 years, you don't want to be taking risk with. And I highlight this because interest rates are so low, Tanya, that a lot of people are saying, my gosh, I'm getting nothing in my savings account. I might as well put it in stocks. At least I'll get a dividend yield, forgetting that there may be that volatility in the stocks or even in bond funds.
Right. So where should you put money that you need in the next 5 years?
Unfortunately, your best options are money market funds and CDs. The good news is it does look like interest rates are slowly starting to move up. But the problem is if you're getting a higher interest rate in those cash vehicles right now, you're taking on more risk.
Right. All right. So now we've sort of figured out what our goal is with this money. When do we want it? When do we need to spend it? But you also say then we need to remember our debt, if we have any, and take that into stock.
Yes, Tanya, because investing inherently is a risky activity. And you hope you're going to get a return, but you're not guaranteed. So if you've got a lot of consumer debt right now, which many people do, especially credit card debt and increasingly student loan debt, any dollar you put towards paying down that debt, that's a guaranteed return. 13% interest on your credit cards, you pay that off, you just made a 13% return. You can't get that anywhere in the markets.
That's right. So pay that off first.
That's
Any
right.
extra money you have,
pay down.
Don't even question it. Now, what about your income? Is there some kind of safety net for investing?
Yeah, that's another great question, Tanya, that a lot of people don't stop and think. If you are, say, a tenured professor, for instance, or a government employee, you actually can take on more risk because you have more security than someone who is, say, self-employed or works on a commission basis.
How so? How do you have more security if you're one of these people?
So, for instance, let's say you're a tenured professor. Unless something really awful is happening, you have a fairly steady, predictable income stream and income trajectory, as opposed to, say, a salesperson who earns money based on commissions and may have this very volatile month-to-month cash flow. And so with the more steady income stream, you know you've got cash coming in, you know you won't have to tap into those investment accounts, and so you can be a little more aggressive with them.
Tenure, it's a good job if you can get it. I wish this business had tenure.
Exactly, I'm with you. Let's start a union.
Both of my parents are tenured professors. Good for them. All right, now, you also say that we need to remember our ages, because obviously age is a factor. Are you close to retirement? Do you have 30 years till you retire? All of that factors in.
It really does, and right now I'm seeing the exact opposite behavior. So young people are saying to me, Manisha, the last 10 years in the stock market, not pretty. And so I don't want to put my hard-earned savings into the stock market. And older folks are saying to me, Manisha, there is no way I'm going to be able to retire unless I knock it out of the park. I got to really look for the big win out there. And those are the exact opposite behaviors. And so a good rule of thumb, if you're a woman, 110 minus your age is the maximum percent of your portfolio to put in stocks. 100 minus your age if you're a man.
Why is it different for men and women?
Because we live longer. So us ladies, we need more money.
That's right. And for other stuff too.
That's right.
Now, what are some of the, I mean, of course, it's never too late to start investing, right? I mean, if you haven't put money away for your retirement. So what are some of the sort of safer investments? Things like index funds, perhaps?
I'm a huge fan of index funds. There are some wonderful actively managed funds out there, but there are just so many to select from that if you don't actively enjoy looking at active managers, index funds are a great, powerful investment vehicle that you can use. And the basic recipe I recommend is whatever portion you're going to put into stocks, put half in a total U.S. market index, half in a total international index.
And these are emerging markets.
So you'd get some developed markets and emerging markets by splitting. You'll get both.
Because right now the emerging markets are doing a little bit better than the U.S. market, isn't that right?
They are. They've had a great run, but the flip side is it's possible that the U.S. markets, which are now starting to look a little undervalued on a price to earnings, price to sale ratio, might rise. So splitting between U.S. and international on the stock side, and then on the bond side, putting half in a total bond market index and half into tips to have that inflation protection.
We're going to dive right in with the first question from Sanjay. He writes in saying, I thought bonds and bond funds were safe, but my bond funds went down last year. How is that possible?
So a lot of people think bonds are safe, and the reason that notion came about is because if you buy a bond and you hold it until maturity and the underlying entity doesn't go bankrupt, you get your principal back with interest along the way. But there are a lot of caveats in there. First of all, the underlying entity can't go bankrupt, so there's some credit risk. And on top of that, with bond funds, there is also interest rate risk because you're not actually holding all of the bonds in the fund to maturity. So as interest rates fluctuate, bond prices will go up and down. And recently, there's been a lot of volatility in interest rates, and so bond prices have seen some shorter-term decline. And that's why Sanjay's seen movement that he hadn't anticipated in his bond funds.
So if you see that decline, you're just supposed to sit tight and wait for it to go back up?
Sit tight, exactly. And ideally what you want with your bond funds right now is to have a shorter maturity or duration, 1 to 5 years, because most people are, well, interest rates can't go much lower. Really, the only direction they can go from this point is up.
Right. All right. Good advice there for Sanjay. Good luck with those bond funds, Sanjay. Now, Janie writes in asking, my New Year's resolution is to be smarter about my spending. Can you give me any tips for how to do that? Great New Year's resolution.
It is, and just like there is a food pyramid, I feel really strongly that one thing that's lacking in America right now is a sense of what balanced spending looks like. And my favorite formula comes from Elizabeth Warren, like the Elizabeth Warren, who's helping us in so many ways in this country. And she wrote a book some years back called All Your Worth, where she laid out a formula, 50, 30, 20. And what that is are the percentages of your take-home pay that should go to your needs, wants, and savings. 50% to needs, 30% to wants, 20% of your after-tax to savings. That's a rough rule of thumb that can help you keep to that New Year's resolution.
That's a good one. I hadn't heard that one before, and that's one to take to heart.
Nice and simple, and you can remember it. 50, 30, 20.
Absolutely. Very good. All right. Good luck, Janie. Now you know the formula for that New Year's resolution. Now here's a question from Roland. He writes in saying, I'm 28 years old and living at home with my parents. I have a lot of credit card debt and student debt and no emergency fund. Should I be focusing first on building my emergency fund or paying off my debt? We've had this question before from different viewers, and we've actually had two different experts weigh in differently. Yeah, so I'm curious to hear what you'll say.
All right, so survey says from this side, my feeling is in this case, since Roland is living at home, if his parents are being nice to him and he's being nice to them, that in a sense is his emergency fund. So at this point, I'd rather see him pay off as much debt as fast as humanly possible and then build up the emergency fund so he can get out of the nest. If he did not have safe and secure shelter with his parents, I would then say build up that emergency fund before tackling that debt.
Okay, so it doesn't sound like he's paying rent. That's what we're guessing.
And that's what I'm assuming correct in my answer. If he's not paying rent, if that burden has been taken off of him, he's in a great position to really pare down on that 30% in the previous formula, the fund, and plow that into debt payback.
All right, Manisha Thakor, thank you so much for that advice for Roland and for all of our viewers who wrote in. That's all the time we have for Good Money today. But remember, go to our website, get out a pen. It's abcnews.com and click on the Money page. And there you can ask Good Money's team of personal finance experts all your finance questions. We'll do our very best to answer them right here on the show.